Hello, fellow Rebel Capitals. Hope you're well. We finally got StreamYard working back in action. So I wanted to go over what everybody is missing about inflation, deflation, disinflation. And this is part of the presentation that I gave at the New Orleans Investment Conference. And just to give you a little curveball, I also want to go over why this makes me more bullish on the United States economy than I was, let's just say, 2 months ago. Not that I'm on net balance bullish, but I'm more bullish than I was. So let's start by going over some slides from the presentation I gave at the New Orleans Investment Conference. And I think this is going to give you guys a whole new vantage point and a whole new I think this is going to give you guys some ideas to think about that you might never have even come across in the past. I've never heard this argument before. And not to say that it's no one out there is saying the same thing, but if they have, I've never heard it. So you guys sit down, buckle up, and I think that you guys are going to enjoy this and give you a lot of food for thought. And again, it's going to give you a vantage point that I don't think many of you have looked through. So let's go over to first slide here. Now, so we got the screen share. Yeah. So Josh, can you see this?
See
you can.
Yeah, we can.
Okay. So this is a chart that pretty much everyone is familiar with. And if I'm going to try to do my best to describe what we're looking at for people that are maybe listening to the podcast. And this is just typical dollar value of the dollar. This chart going back to the beginning of the Federal Reserve and how you just see this downward decline. I mean, everyone has seen this chart, has seen this meme. Now, if I were to ask most of you watching this video or listening to this podcast, why has the dollar declined? What you're going to hear from most of the people in the Bitcoin space or the gold space or the sound money space, or for any really, I don't think this idea is exclusive to those individuals, but what you're most likely going to hear is it's because of money printing. Well, the government is printing more money. Therefore, there's more currency units in circulation. Therefore, the value of those currency units is decreasing. This is, I mean, you just go on Twitter, you go on any place. I mean, you listen to any podcast, and it's just, that's all you hear. Well, the government is they're printing money. They're China, they're going to print money. The United States, they're going to print money. They're going to print money. Well, the government's going to print money. And that is the number one reason, and pretty much the only reason that you ever hear as to why we saw this decline in the purchasing power of the dollar that is illustrated by this chart. So to start, I want to go over how most people see this. And most people that have maybe even a little more sophisticated view, because most people that have researched this, if I said, is the government literally printing money? They'd say, no. But what's happening is the government is selling treasuries. The Fed is buying those treasuries, and they have been buying those treasuries since the inception of the Fed. And because there are more bank reserves that are created by that process of the Fed buying treasuries, then this gives the banks more money to go out and lend, and then they lend this on a fractional reserve basis, and then you have an increase of M2 money supply. But it all goes back to the government spending and the Fed, quote unquote, monetizing the debt. That's where the money printing is coming in. And then this increases the balance sheet capacity for the banks. They go ahead and lend more money than they otherwise would. And this creates additional M2 money supply. And that's kind of the process from A to Z that most people just summarize as money printing. So just let's hold that thought for a moment. And now let's look at the Fed's actual balance sheet. And I had one of my editors create this, and this is the Fed's balance sheet minus currency in circulation. So why am I subtracting currency in circulation? Because nobody would argue the banks are actually lending green pieces of paper, right? Like if you go down to a bank and get a loan for a mortgage, let's say a $500,000 mortgage, they're not going to be giving you $500,000 in a suitcase. They're going to be creating new ledger money, if you will. Their new commercial bank deposit liabilities, and the offsetting asset is going to be that loan they just created. So the argument there, again, going back to the previous chart in money printing, isn't necessarily that the government is or the Federal Reserve is creating green pieces of paper to buy these treasuries. No, again, it's that they're creating bank reserves, and those bank reserves, asset of the bank, increases their balance sheet capacity, increases M2. So that's why I want to focus specifically on bank reserves. So if we look at the amount of bank reserves in the system, call it from 1940 to 2007, we can see that around 1940, there was around 10 billion worth of bank reserves. Okay. 10 billion with a B. Then we fast forward to 2007, and there was around 40. So an increase of 30 billion over the span of, call it 65 years. So now if we go back to this chart of the dollar, let's go back to 1940. We can see the dollar back then had, let's just call it $19 of purchasing power, and that same dollar today only has $1 of purchasing power. So, and let's just actually, yeah, it's pretty much the same if you go back to 2008. So it has declined, the dollar has declined in value by almost $19 in purchasing power from 1940. But the amount of bank reserves went up by 30 billion, the B. So here you can tell is where this idea starts to, let's say, wobble a little bit. How could we have created, or how could the dollar have lost that much value over 65 years when the Fed, quote unquote, printed $30 billion? $30 billion. I mean, Warren Buffett has that in his checking account. So you're telling me that by the Federal Reserve printing $30 billion, it decreased the value of the dollar to that extreme, to where it was worth almost $20 of purchasing power, and now it's only worth $1? You see, that in and of itself doesn't really make sense, does it? It's kind of a head scratcher, right? You're like, wait a minute here. How did government money printing, if they only printed $30 billion, lead to that decline? There's got to be something else going on. But it gets even more crazy when we look at this next spreadsheet. So this is the H3 data. And you can see right here, we're looking at 2006, 2007, and we got August of 2007. Now, what's interesting about this is it actually breaks down the bank reserves for the bank, because see, what we do today, which we didn't do back in 1940, is we actually included vault cash, or actually include, I shouldn't say included, we now include vault cash in that equation for bank reserves, where, as you can see with this chart, prior to 1959, we didn't do that. See, prior to 1959, the only asset of the banks that was included in bank reserves were the electronic reserves. And again, at the end of the day, you think about this and what are the argument for the bank reserves increasing balance sheet capacity is that the banks have quote unquote more money to lend, or in reality, they have more money to settle transactions for those loans they create. And so we scratch our head again and say, well, wait a minute, why would vault cash increase a bank's balance sheet capacity? Because they're not using vault cash to lend out money. They're not using vault cash to settle with other banks in interbank settlement. It's not like Wells Fargo is sending a Brinks truck to Bank of America every single day and back and forth. No, of course not. They're settling in electronic bank reserves. The only reason they have vault cash is just for customers that come in and say, hey, I've got, $10,000 in my checking account and I want to take out $2,000 to buy a scooter or something like that. I want to pay for it in cash. So the bank has to have that vault cash so that they can give that customer the cash that they're demanding, hence demand deposit. So again, if we are to look at the actions of the Federal Reserve and how they would apply to a bank and their lending, you have to strip out vault cash. And you've got to focus exclusively on the electronic bank reserves. So here's where it gets really interesting. Because if we go back to 1940 and then we fast forward to 2007, we want to compare apples to apples. Because remember, post 1959, the bank reserves in total included vault cash. So we want to strip out the vault cash and look at 2007, and then we can compare it with 1940 roughly, and we can get an apples to apples comparison, and then we can really see how much money the Federal Reserve printed that would equate to bank lending, which would equate to the value of the dollar deteriorating to the degree to which we see in that initial chart. So I have the amount of electronic reserves. Again, we're stripping out vault cash. I've got that highlighted. So right here in August of 2007, you can see it was at its peak for this time frame, and that was 10 billion. Call it 11 billion. 10.9. It's like 8. So let's just call it 10, 11 billion in August of 2007. Again, I'm going to repeat just so we're all on the same page here, at the sake of being redundant. There were 10 or 11 billion dollars worth of electronic reserves or Fed money printing in 2007. In 2007. Okay. So what happens is if we look at this next chart and compare the amount of electronic reserves in 2007 to the amount of electronic reserves in 1940, you get, well, it's to my left. You guys can see it right in front of you. You get this red line, which you can see is flat. In other words, we had about 10 billion in electronic reserves in 1940, and in 2000, about 10 billion of electronic reserves. No change at all. Now, in the middle, there's a little bit here and there, but over the span of that, call it 67 years, we've got flatline. Effectively, no change at all. In other words, just to say this a different way, the Fed didn't print any money. There was no money printing, at least not by the Fed or the government. Now, were the banks printing money and expanding their balance sheet, creating more M2, which would have contributed to the decline of the dollar? Absolutely. Absolutely. But when you hear people say, again, going back to this chart here that we're talking about, when you ask people what the cause was, they never say banks printing money. They never say bank lending. They always say government money printing. But that's not possible. It's not possible. And this is not George Gammon's opinion. This is empirical. And the reason I can say it's empirical is because you just look at their balance sheet and it didn't increase as far as those electronic reserves that would be categorized as quote unquote money printing. And I know this just, the people in the gold space and the Bitcoin space and the Austrian space, this makes their head explode. And they freak out about this stuff. But look, don't shoot the messenger. And if you're telling me that I'm crazy or I'm stupid or I don't get it, that's fine. But don't tell me I'm stupid. Argue with the chart. Just argue with the data. And you really can't, because I'm just presenting the facts as they are. This is not my opinion that the Fed didn't print money. They literally didn't print money. Now, if you look at their balance sheet, let's do that right here. And I have just taken, what is this? This would be, I really have to zoom in here, guys. Let's see. That is 1968. And then we go to 1999. And this is just to give you an idea of what the conclusion that most people would come to if they look at the Fed's balance sheet and why it's inaccurate, right? We discussed this briefly earlier. So this is the liability side of the Fed's balance sheet down below, based on this timeline. And this is the asset side. So if you look at the green shaded area, that represents currency in circulation, okay? The pink represents bank reserves. You can see it doesn't change much. And the bluish aqua color on the asset side of their balance sheet would be treasuries. So what most people do is they look at this and they say, oh my gosh, well, of course the Fed is creating currency units, because you can see the amount of treasuries that are on their balance sheet increase. So, George, this defeats your argument. But you see, that's a fundamental misunderstanding as to what's happening. So what is happening right here? Why are they buying treasuries? Well, because they're buying treasuries as a result of the banks having demand for currency in circulation due to the fact that they're lending and creating more money supply. And therefore, if they have, let's just take it to an extreme. Let's say they create $1 of new money supply, the banks through lending. Well, that means that there's a maximum of $1 of currency in circulation that's going to be required from the Fed or via the Treasury, right? Now, let's say they create $1,000 worth of loans, right? Well, now you've got a maximum of $1,000 of currency in circulation that could be demanded at any point in time from that customer or customers, right? So you would assume that as M2 money supply goes up as a result of bank lending, that demand for green pieces of paper would also increase. So how does that process work? Well, it's actually pretty simple. What happens is if the bank has a customer that wants, let's just say $100, just to keep it super simple, and the bank doesn't have any vault cash, they're out. So what the bank would do is they would call the Federal Reserve, and the Federal Reserve would say, yep, we're going to go ahead and print that up. I think they do that via the Treasury. And tomorrow we'll go ahead and send you a Brinks truck with that $100 bill, and then you can give that to your customer. So that's exactly what happens. Now, on the bank's balance sheet, when they give that $100 bill to the customer, well, what happens to the liability side? Well, it decreases by $100 because that customer had $100 worth of electronic deposit liabilities, right? Or from the customer standpoint, it was $100 worth of electronic assets, right? Their account balance was $100. From the bank standpoint, they had $100 worth of commercial bank deposit liabilities. So what happens is when they give that $100 to the customer, well, what happens to their account balance? It goes from 100 down to 0. Meaning that the liability side of the bank's balance sheet decreases by $100. Well, that's not all that happens. You see, the Fed doesn't just give them that $100 for free. What they do is they decrease the amount of bank reserves that that bank had in their account by, you guessed it, $100. But now what has happened is the Fed has decreased well, they haven't decreased the size of their balance sheet because they just swapped a bank reserve for currency in circulation, right? It's the amount of liability, because those are both liabilities of the Fed. So the Fed's liability balance side of the balance sheet doesn't change. But what does change is the amount of reserves in the system. So let's just say that they had 10 bank reserves prior to this transaction. Well, now all of a sudden, since they decreased the amount of bank reserves in the system by $100, now they've got, let's just say, 9 bank reserves. But they wanted 10, right? That's where they started. So what are they going to do? They're going to go out there and they're going to buy another treasury to give them another bank reserve to get back to where they were prior to the bank asking for the $100 to begin with. You see? So my point is, if you guys were able to follow that, this increase in the Fed's balance sheet with green pieces of paper, this in no way, shape, or form impacts the bank's ability to lend. And it in no way, shape, or form really impacts what the government is doing, because it's happening at such a really a minuscule level, right? This is just really a result of banks, first and foremost, increasing the money supply by increasing lending. So it's the banks doing something first. It's not the Fed, it's not the government, it's the banks. And then what happens is the customers come in, they want more currency units. So because there's more currency units being demanded, the Fed supplies the currency units. And part of that process includes buying another treasury. This is why you see the Fed's balance sheet expand like this. It has absolutely nothing to do with quote unquote, money printing that would lead to higher consumer price inflation. Right? Because if there was no bank lending, you wouldn't see the Fed's balance sheet increase, because there wouldn't be any additional demand for green pieces of paper. Okay, moving on to the next argument for the Fed, quote unquote, printing money, and this leading to the decline of the dollar, is you'll hear a lot of people say, well, George, but they're keeping, I get what you're saying about the reserves, and it's true. They didn't really increase the electronic reserves. There's no disputing that. It is what it is. But what you're not considering is the fact that the Fed keeps interest rates artificially low. And since interest rates are artificially low, then this increases demand for loans. The banks supply those loans, and there are more currency units that are being created than there otherwise would be if we had a market interest rate at the front end of the curve. Okay, so let's just analyze this prior to QE. Prior to QE, if you read a textbook, the way they described the Fed micromanaging interest rates, or the overnight interbank rate, was them just doing these little teeny, what they call open market operations, where if they wanted the overnight lending rate to come down, they would just add a few reserves to the system. If they want it to go up, they would just subtract some reserves. So let's just look at this and assume for a moment that there's only one bank reserve in the system for interbank lending, and that the interest rate, the Fed funds, is 10%. That's their target rate, right? So if the Fed wants the interest rates to go from 10% down to 5%, well, they would just add another bank reserve. They'd buy another treasury, and then we would just have more supply of those reserves for the banks for interbank lending. More supply, price goes down, so we go from 10% down to 5%. Okay. Well, this is the way that all the textbooks tell you the Fed micromanaged interest rates prior to QE. But let's look at this empirically. So right here on the top, we've got a chart of the amount of reserves, and we'll just focus on 1980 to 2007 because we know that interest rates came down quite substantially, right? I mean, 1980, that's when Volcker supposedly broke the back of inflation by taking Fed funds up to what, 18%, we'll call it. And then prior to the GFC, we know that Fed funds right around 5%, 5.25. So what would happen here is the amount of bank reserves in order to get that interest rate from 18% down to 5%, the amount of bank reserves in the system would have to increase a lot. And not just bank reserves, because remember, we've got to strip out vault cash because banks aren't using those for interbank transactions. We'd have to focus exclusively on the amount of electronic reserves. Okay, well, in 1980, the amount of electronic reserve, or the amount of total bank reserves, 44 billion. 2007, 42 billion. So it went down, not up. But there's more. If we look at the amount of vault cash that was in the system in 1980, it was right around 10 billion. Well, we fast forward to the amount of vault cash that was in the system in 2007, and it was right around, call it 45. See? So almost all of the it depends on the date here, right? But the point is almost all of the bank reserves in the system were currency in circulation. So my point here, takeaway, is that from 1980 to 2007, the amount of electronic reserves didn't decline by 2 billion. It declined by almost 40 billion. But yet, somehow, interest rates, Fed funds went from 18% to 5%. Just explain to me for a moment how that's possible if the Fed kept interest rates artificially low, or if the banks were actually using those bank reserves. And if the banks aren't using the bank reserves, if they don't need the bank reserves, then how on earth can you assume that the Fed and the government creating those bank reserves would lead to this decline in the value of the dollar? See, the argument really doesn't add up if you scrutinize exactly what is being said, but nobody ever does. Nobody ever does. I mean, have you ever, in all the podcasts that you guys listen to, all the videos, all the experts, the CNBC, whatever, have you ever heard anybody talk about the fact that the amount of electronic bank reserves from 1940 to 2007 didn't increase? That basically the Fed did nothing other than just sit back and provide currency in circulation for banks that needed it because depositors wanted it? That's all the Fed did. They're just basically an ATM machine for people that already had money and just wanted to exchange the electronic money for the green pieces of paper. So it's just, they're swapping. There's no increase to M2. M2 already existed. See, no, I've never heard anybody talk about that. But yet it's fact. It's fact. Whether we like it or not, it's, it really breaks quite a few of the narratives out there. But, look, you can choose to just bury your head in the sand just because you want a narrative to be true, because you've built your worldview around that narrative. But that's not George Gammon. That's not what I'm going to do. Even if I have a preconceived notion and I've, to a certain degree, built my worldview or even my YouTube channel around a certain preconceived notion, if I discover that that's not true, I'm not going to double, triple, and quadruple down. I'm not just going to bury my head in the sand. I'm saying, whoa, wait a minute here. No, that's not true. I need to re-examine this whole entire argument. I need to re-examine this. I was going to call it a hypothesis, but this is just what people consider to be fact, just because it's one of those things that's said over and over and over and over again to the point where people don't even research it because they don't even think it's worth researching, because so many people have said it that it must be true. But when you look beneath the hood, which I've never seen anybody do, then you see that this whole thing breaks down, this whole narrative. So now let's move on to why I'm actually bullish, because it dovetails on exactly what I was talking about. So we can all agree that the decline in purchasing power of the United States dollar is not a good thing. So if you're watching this, you're probably saying to yourself, okay, George, I get what you're saying, makes sense, but why did we have a decline in the dollar? Was it just the banks lending that created all this currency without creating more goods and services? No, I would not blame the banks, because the banks, without the government, like we said in our last video, are just simply going to lend for productive means, right? But what happens is when you interject the government, now it changes everything. And now all of a sudden we're going to have let's switch over here. Looks like we've got a problem with the camera. Josh, when did this happen?
Like 2 minutes ago.
Okay. All right. Bear with me here, guys. All right. Give me 2 seconds, guys, and we'll just switch up the camera. Yeah, next time that happens, Josh,
you were on a good tangent, and so I was waiting for you to finish that sentence.
Yeah, next time. So now I'm looking at my computer, guys, so you'll just have to forgive the background, but that's not really important for this video. So now let's go back to the screen share that we had. Here we go. So did you see this? You had this pulled up before, right, Josh?
Well, we could always see everything on your screen.
You just didn't see me for the last 2 minutes.
Yeah.
Okay, cool. So just getting back to where we were, guys. The argument here that I'm trying to make is that if you were to exclude the government from the banks, right, you would have bank lending go back to what we saw in the late 1800s, when we had this era of free banking, where they were lending far more productively. So the increase in currency units was combined with an increase of goods and services, which is why, in my view, you didn't really see a decline in the dollar. In fact, you actually saw the dollar appreciate against goods and services back in, let's just say 1880 to 1900. It wasn't because we were on a gold standard, because the amount of M2 money supply that's been created since, let's just say 2000 to 2020 was the exact same amount that was created 1880 to 1900. So it wasn't the gold standard. That's fake news. It was the fact that these banks were lending for productive purposes, right? So now here's the punchline. Why is it, George, in your view, this is just my theory as to why we saw this decline in the dollar, you see that this pretty much matches up with the amount of government spending as a percentage of GDP. So I think we would all agree that as the amount of spending or the government share of economic output, let's just say, if it's at 5%, which is what we saw, let's say, prior to the Fed, especially at a federal level, you would assume that if the private sector was creating 95% of the economic output and the government only 5%, that the economy would be extremely efficient. We'd be creating a lot of goods and services. And therefore, if you have a much more efficient economy combined with the exact same increase in money supply from the bank lending, you have a lower degree of consumer price inflation, if not outright deflation, the good type of deflation, where the purchasing power is accruing to the poor and middle class and savers, if you will. So this, in my view, is the culprit. You can't. Now, look, should we end the Fed? Absolutely, but for much different reasons. We can't sit there and say, well, if we end the Fed, it solves all of our problems. No, it doesn't solve any of our problems. In terms of what we're focusing on. Now, does it solve a lot of our problems as far as them not being able to bail out and therefore the banks not having a lender of last resort, therefore they're going to be more responsible, therefore going to be more productive lending? Absolutely, absolutely, absolutely. But if we get rid of the Fed, it's not going to decrease the quote unquote money printing, right? Because that's all happening as a result of the banks. It's not happening as a result of the Fed. We can blame them for a lot of things. We can't blame them for that, just empirically. So in my view, the reason you have this decline in the dollar is because you have the share of government spending as a percentage of total economic output increasing to the point today where it's called 50%. So, I mean, just an easy thought experiment. Which economy is going to be more efficient at creating goods and services? The one where the private sector represents 95% or the one where the private sector represents 50%? Easy answer. And if you have the exact same increase in M2 money supply with a much more efficient economy, then would you expect consumer prices to go up or down? You'd expect consumer prices to go down. And if you have the exact same amount of increase in M2 money supply with a very inefficient economy as far as producing goods and services, would you expect prices to go up or to go down? You expect prices to go up. So this brings me to why I am more bullish than I was, because it goes back to this Doge, right? So here we go. And so you say, well, George, you said in your last video that it really wasn't that important to reduce the deficit. What's more important is to reduce the regulations. Well, that's true. That's true. Because why I'm saying that is, even if you don't decrease, let's go back to this. Even if you don't decrease the amount of nominal spending for the government, just keep it the same. Just keep it the same, for heaven's sakes. Let's just say that this 50% of GDP right now is, what would it be? Let's just say it's 15 trillion. Yeah, and keep in mind, this includes state and local as well. Well, let's just say it's 15 trillion in an economy of 30 trillion. Okay, great. Well, to get the percentage down, to increase the percentage that the private sector is contributing to economic output, you don't necessarily have to get government spending down in nominal terms, although that would be great. What you really have to do is you have to get the growth, the GDP part of the equation, up, up, up. So my point here is it realistic for them to cut a massive amount of government spending? Probably not really, because to people's point, most of that spending is Social Security and defense and these things that really aren't going to be cut. But what you can do is you can have these guys come in, just say the team Doge here, and you can have them reduce the regulations. You can have them reduce all of these things that completely hamstring the private sector. Therefore, you have the private sector creating more goods and services, being more productive, creating more economic output, even if government spending is staying the same. And if the economy, the GDP, due to the private sector and the reduction of regulation, is going up, 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 but the government spending is even staying the same, then the amount of government spending as a total percentage of GDP goes down. Goes down. And as the government spending, if my hypothesis is correct, as the government spending as a percentage of GDP goes down, then I would expect the value of the dollar possibly even to go up, depending on how much, you know, how much we could see this chart decline. And even if it doesn't go up, I mean, at least flatten out to where it's not losing as much as it typically does. So the good news here is that this is not about the Fed printing. It's at least this, chart right here. This is not about the Fed printing money, and therefore we should end the Fed, but we don't have to end the Fed in order to maintain the purchasing power of the dollar. I think Doge is far more important. And if they're able to, again, even if they don't cut government spending, even if they're able to get rid of all these crazy regulations and red tape and bureaucracy that's just a ball and chain to the private sector, in my view, that is a huge win. And I'm not saying that we're going to have outright deflation or, the value of the dollar is going to increase, but I think it would at least decrease to a lesser degree, especially if they're able to achieve these objectives and have a compounding effect. So you fast forward 5 years, 10 years, and maybe, just maybe, we go from government spending at 50% of GDP, maybe, just maybe, we get it back down to 30. And that might not be as good as the late 1800s, but 30 is a hell of a lot better than 50. In other words, the private sector creating 70% of the economic output is a hell of a lot better than the private sector creating only 50% of economic output. So that, guys, is why I think everyone kind of gets inflation wrong, or what they're missing about inflation. And that's why on net balance, I still think we're going to have a recession and a decline, especially of the global economy. But coming out of that, I'm far more bullish, optimistic than I was, let's just say, 2 months ago. So Josh, on that bombshell. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.